The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as expected on Wednesday, we got a Federal Reserve rate cut. What does that mean for the markets? What could that mean for the broader sector moving forward? Plus, what about the grains and oilseeds and livestock trade? Some pressure there on Wednesday. We're going to talk through things. Joining us now for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, great to have you join us here once again today. And as I mentioned, as expected, 25 basis point rate cut from the Fed.
Yeah, and Jesse, what we're going to try and attempt to do today, and hopefully we'll be successful, but if not, be sure to sign up for a 2-week free trial at the website at globalcomresearch.com. And in that free trial, you can put some comments and say, call me about what you talked about with Jesse, because this is pretty heavy duty stuff. We've talked a lot about a commodity demand low over the last couple months. I've laid off of that because we've been waiting for the Federal Reserve, and there's been a couple other things that have risen to the top that have had more importance that we've needed to deal with. But I think it's time at this stage of the game, with a new 43-month low in the US dollar, for us to talk about the Federal Reserve and macro policy. For me, at this juncture, is probably the second most important factor after the harvest weather in determining what the fall price trend for crops are going to be, because of the fact that we are seeing that dollar weaken and that demand come on. And I think we're on to something with talking about a commodity demand low. And what I like most about what you just said was, you're exactly right. The Fed not only cut the rates a quarter point as expected, the Chicago Fed tool that the Mercantile Exchange has for us to use suggested the bond market was already pricing in 3 total rate cuts this year. The Fed came out and said, we're looking at 2 more by the end of this year. The market's very clean. There's not a lot of noise. There's not a lot of dirt to have to work around. And so this dollar becomes extremely important and valuable. Why? Because the connection with the dollar, with some of our big currency partners, big importing partners, and the emerging markets. And so it's something I wanted to kind of go through, with the idea that not only is the dollar at a 43-month low, the Brazilian currency is at a 15-month high, Mexican peso, 14-month high, the offshore Chinese currency, 11, 12-month high. And now all of a sudden we're starting to see the crude and the wheat come together. And that was a big issue for us a couple months ago when we talked about this. And when I talk to clients and they say, should I be stepping into the corn market? And I always say to them, almost always say to them, I can't until I see the wheat and the crude oil get a bottom underneath them and a floor underneath them first. Well, this hopefully video will help answer why that is.
Well, let's talk about that dollar first and look at some of the things there and the dollar chart. And you mentioned the low. Now with this rate cut, do we think this low holds? What is the trajectory here for the U.S. dollar, Mike?
There are more people in the financial FX markets that I listen to that know a lot more than me, that are still price negative or bearish the dollar right now. And this is important because some would say, well, okay, you got 2 factors there, Mike. You've got Federal Reserve macro and you've got weather. What about the U.S.-China trade relationship? Part of the reason the dollar is selling off is because of the fact that we have not done anything with China, the fact that we have not gotten anything done with India, the fact that de-dollarization in the markets is starting to grow in terms of other countries trying to work around getting out from under the US dollar. But at the same time, our goods are getting cheaper and cheaper and cheaper, and we see that in the wheat. So to answer your question, I would say I've not seen a time period in probably 5 years, and I think back to 2021, and that's the next level of support that we're really digging towards at this point with these new lows. And we did make a new low for 2025 today. That 5-year time period was the last time I really remember at like a $96, $98 level. Bears were still on the hunt to take the dollar lower.
Well, thinking about the dollar, and then let's flip it over and talk about something that you and I haven't talked about this in quite a while, the Bloomberg Commodity Index, roping that in with some of this economic market picture and more after the Fed rate cut. What can we take away from looking at the commodity index, Mike?
Yeah, I'm really glad you said we haven't talked about it in a while. And part of that's because of the Federal Reserve. Part of that is because the fact, and they haven't been cutting. Part of that is because of the tariffs. And part of that is because of the New East, New West alliance that we're finding geopolitically and from a trade standpoint of China, Russia, especially hooking together with Brazil, trying to reel India in and trying to reel some other countries in to increase not only their geopolitical strength, but also their trade strength. And that is the heart of the de-dollarization mindset. But if you look at this chart going all the way back to 2004, the last time we made a really good commodity demand low, and I've referenced that in the past with you, I think, is it was really led by the emerging markets and their stock markets lighting up and going higher. And if you take a look at the red line now, look at where we are. We're not only at the highest since June of 2021, but that level of June and May and April of 2021 was also the level we got up to before the financial crisis. And when that emerging market goes higher and those equities go higher, that's what drives their currencies higher, their buying power higher. As a result of that, when the Fed cuts interest rates, they weaken our currency more. It frees up money for riskier assets, and it keeps inflation alive. And in fact, the Federal Reserve Chairman just said 5 minutes before we started taping this that he is seeing inflation for goods continuing to go up, inflation for services to continuing to go down and be more disinflationary. That spells to me that more money managers should want to get more commodities underneath them, just like the gold making record highs. Now we probably know why it's been making record highs. And this chart right here has a lot to say about the commodity demand low and whether this Bloomberg Commodity Index can follow the emerging markets and that ETF that's in the red like it has in the past. If not, I'm going to guess it's because of the tariffs and it's because of some of the things that are different than what we had going back in the mid 2000s. But to me, bottom lining it out, Jesse, this is the best opportunity for us to nail down a commodity demand low that I've seen probably since COVID at this stage of the game.
You mentioned it in the open, looking for wheat and crude to link up. Let's go there and talk about that. SRW wheat against WTI crude and some of the correlations here. And, you look back at history here, Mike, through the last year plus, and some of the times where the two markets connect up. Pretty clear to see on a chart. What stands out to you right now?
Yeah, this is a really key feature. It's not ready to go yet. In other words, the correlation, that's the yellow bar at the down part of the chart there, that 0.965 means that on a 3 to 4 week basis, WTI and SRW are now running at about a 96.5% positive relationship to one another. I'd like to be able to tell you in a couple, 3 weeks that we're running an 8 week or 10 week or 12 week correlation on this chart that is up at 90 or higher percent. That would give me the mindset that we've made some lows at this stage of the game. But this is the early running chart. This is more the high frequency chart saying over the last 5 or 6 weeks, we've started to see these markets come together again. And this matches up with that weak dollar principle. It matches up with this week's trade where we had such a strong move in the wheat after the WASDE report. And it was really surprising to the trade. But if you look at it from a currency and macro and being prepared for the Federal Reserve, it makes a lot of sense. And go back, 12 months and say, why in the world are we still sitting at near 3-year, 4-year lows in crude oil, but we continue to make record highs in the stock market, even the stock market that doesn't have a lot of the tech stocks in it. And so you've had this disconnect. And I think this soft red wheat crude oil chart relationship and price relationship brings a lot together in terms of where you're at when it comes to the demand sentiment and not having to worry about more supplies coming onto the market, but instead thinking, hey, we've probably made our lows here. Demand's really coming on strong. And we've seen that in the wheat exports. We saw it Monday. Hopefully we'll see it again on Thursday morning.
Could wheat and crude oil, whatever we're kind of tracking here, if we can get some linkage, could that spill into the corn market here, Mike? Let's talk about that. What are you seeing on the weekly corn continuation chart?
That's a really good question. I'm inclined to say this chart is pretty messy. It's a weekly corn. We've had now five after last week, 5 straight weeks higher in a row. When was the last time we did that? It was back in the same time period as last year. And notice what we did, Jesse. We had 3 weeks up. SEP futures went off the board. D's took over, and we had 3 more weeks higher. But notice the week after the report of last year, the Federal Reserve came out as well during that time period. And notice that we made a low in the corn and we closed on the low, but we didn't fill the gap coming back the next week. The low from the 1 week where the gap was made, and then the second week we opened where that gap was made, but we cleared the previous week's highs. And we essentially said we're not going down there to fill that gap. And we had, therefore, a couple more weeks upside after the gap was made. This is the kind of sentiment that I think is still present in the corn. To answer your question, I think the corn can find some more upside with the help of the wheat and with the help of the crude oil here at this stage, but we don't want to see a change in the dynamic of what we saw last year. In other words, close another week higher this week, keep the gap, and then see what happens next week. The other thing I'll throw out to you is when you think about the corn and you think about the harvest, and this weather and the wet weather coming in, if this wet weather comes in as advertised, I think that will be a supportive feature to this market because by and large, I would say 85% of the clients I've spoken with that are shelling corn right now are no better than last year. And a good portion of those are running below last year. And I'm talking about in West Central Illinois as well. And this matches up with my mindset that USDA is too high for the state yields in Illinois, Indiana, and Ohio. And so if you add that onto the pile, you have a reason to believe that we could still price out this market kind of similar to what we did last year and essentially make a high as we get to early October, end of September.
Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. Let's look at the soybean complex and then let's spend some time in the cattle trade. But, looking at soybeans, I know bean oil was under some hefty pressure Wednesday. We got the EPA news, their proposals for SREs and more that came out Tuesday. Wondered if that had some impact. Of course, we're just tracking price action in general at the Gulf and over, in South America and more. So what's your feeling when you look at this soybean complex, big picture, world perspective here, Mike?
Yeah, big picture, I would say that at the start of this week, when you look at lead month futures, corn, beans, and soft red wheat and corn down about 30 cents, 20 to 30 cents from the end of December of last year. Soybeans up about 50 cents from the last year's close. You can see why that is because along with the soft dollar and that 15-month high in the Brazilian currency, we've got the Brazil and the amazing demand that China has put in front of Brazil. You've now got Brazilian beans at $12.40 and essentially $1.20, $1.25 higher than where we're at right now. So we're very competitive. But I would also say that this is where the U.S.-China trade negotiations, we probably have some premium in the soy complex with the trade expecting some good news. And both Eastern media and Western media this week, Jesse, have suggested that we will, between the two presidents, talk about trade and talk about agriculture trade. So I would say that coming into next week's trade, I would still put the beans as the most susceptible to the downside, even with the weather probably baking some of this crop. But in the short term, I'd be a little bit more nervous about the beans if we didn't get good news out of the U.S. and China. And I think your bean oil comment helps support that. I did think that we rallied Tuesday in part because of EPA shoving those exemptions back to big oil or proposing that at least. We didn't see the follow through, though, on Wednesday, and I was disappointed with that.
Well, and thinking of U.S.-China news, talk of the TikTok deal, but I think a lot of farmers would rather see a soybean deal. So we'll see if that does come to fruition. Let's go over to the cattle feeders. Now, a lot of pressure there on Wednesday in futures. And again, it's something we've been starting to talk about the last several weeks, Mike. Just more volatility across this cattle complex in general. We'll go higher, we'll come back lower, we'll chop around. What are you seeing in October feeders right now?
It's amazing to me how much this market makes sense when it comes to how the feeders and the corn have worked with one another. One is a percent leader on all ag commodities one day, and at the same day, the other one is the percent loser. And vice versa on Monday. Feeders, the percent leader to the upside, corn, the percent leader to the downside. This really suggests to me the funds and the investment flows are really having a tough time managing all the new fundamentals. And I think that's why I'm more excited about a commodity demand low, but I will feel a lot better after Friday or next Monday seeing follow through in what we're talking about today. In other words, we've made this new 43-month low in the dollar. The Fed has said we should continue to see this low because the interest rates will be continuing to come in each month or the next couple months before the end of the year. Same with the crude oil, same with the wheat, same with the cattle, that the funds and the fundamentals need to be coming together here. And I think that's the battle that's going on right now. To me, it's a clinic in the feeder cattle and the corn, what the power is of the funds versus the fundamentals. Cash steers are not backing down hardly at all. Year-to-date slaughter for fat cattle is down 7%, but production's only down 4.3%. We're still hanging around 240 in the steer prices, even though the box beef prices have started to give way pretty nicely. USDA in their WASDE report came out with a $5 increase for 26 cash steers, stoking it up to $249. You've got enough things out there. Retail sales report was up 0.7% for restaurants, saying the Wall Street money is still feeding the consumer. And the Bureau of or the Commerce Department actually noted the wealth effect from Wall Street when they talked about the retail sales. And so my mindset is we are deciding right here, right now, what kind of trend we're going to have. The charts show that, the fundamentals suggest that, and I'm going to be very eager to see how we shake things out at the end of this week.
Well, the end of this week is the next cattle on feed report. Let's talk about that here as we close things out today. And, curious to see what these numbers say. We have the pre-report estimates out. What are you going to be watching for closely with Friday's cattle on feed, Mike?
Part of the reason I think Wednesday's trade was weaker, other than pre-positioning ahead of the Federal Reserve update, because I think I saw kind of a commodity-wide liquidation, just get out before the Fed comes out. So that would say, let's get back in, or are we going to wait until the cattle on feed report? We may want to wait to the cattle on feed report if we're the trade, because that on feed number as of September 1 at almost 11.1 million head, that means we're less than 1% lower than we were a year ago. And that really keeps us elevated in terms of slaughter potential and production potential with these bigger dress weights at this stage, Jesse. So I really don't want to see as low of a marketings number for August. I think we had a very good marketings month for August. The beef retail numbers were up 10 to 14%, pretty much the whole month of August based upon USDA's numbers. I want to see lower than 11.1 million head on feed as of September 1.
Well, and it's going to be interesting to see how this shakes out in the final chart, just looking at that feedlot capacity here and seeing some of the trends from last year and compared to this year and more. And, there's been so much talk, Mike, about are we rebuilding the herd? What are we doing in the countryside? When is this going to start to happen? When will, beef prices, cattle prices pull back? I think it's anyone's guess really at this point here, Mike.
It is. I think you make a huge point that even the ranchers have not really decided yet whether they want to retain heifers or whether they're going to go into the feedlots in a few months. And that's where that last chart really is a big deal for where we're headed in prices, because this is the seasonal time period where we build the cattle on feed number. That G at 11 million head is where I'm at. The trade we just saw was at 11.1 million head. I'm not seeing as big of an increase, and I don't see as big of an increase as we saw last year at this point. But if I'm wrong, that's where it's suggesting we're not retaining. We're going ahead and getting nervous about the cattle prices. And I would say if I would see something like the blue line, Jesse, it would be because of the screwworm and the border being opened up. Otherwise, if the border stays closed, I do think we'll take the chance and retain. So these next couple months are really big months for where we stand on the trend of the on-feed numbers.
Mike, any final thoughts for folks as we close out the show today? Anything you'd reiterate?
Just reiterate one thing, and that is I think we're on the path for a commodity demand low. The corn looks still a lot like last year because of the beans and the wheat coming on for the ride, but we need that dollar to stay weak and not jump after this Federal Reserve because we got a very clean market right now.
Mike, again, if folks want to reach out and have a conversation with you there at Global Commodity Analytics, what's the best way?
Best way is globalcomresearch.com, and it's globalcom with 2 M's. Research.com. As I said, you can get for 2-week free trial. Just fill in 2 questions there and we'll send it off to you.
Mike Zuzolo, Global Commodity Analytics. Always appreciate it. Thanks for joining us on the show, and we'll look forward to hearing from you next week.
Thanks, Jesse. Appreciate you having me.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.